Hello, everyone, and welcome to the YouTube channel of Being ACCA. This is Tushita Gupta, ACCA affiliate, and we are resuming with our chapter wise revision series. We are currently on chapter number 15, which is regarding cash management. So, this pertains to, how much cash a business should be having and, how should they manage it, basically their cash so that they, have both profitability as well as liquidity. So, the first thing that we learn in cash management is what essentially is treasury management. So, treasury management is the first thing that you learn in this chapter. Basically, treasury management, if you want to put it into a definition, it's nothing but, efficiently managing your liquidity and risk in a business, including, so basically, this is about efficient management of liquidity and risk. Now, over here, you will do it for funds, you will do it for currencies, and you will also do it for cash flows. So, everything which relates to cash, it could be foreign currency also. So, treasury management takes care of the efficient management of all of these three things which I have put down in front of you over here. Now, a lot of organizations have a centralized treasury department. What does that mean? Let's suppose I'm a very big organization. I have my operations in a lot of countries. So I have my branches in US, UK, China, India. So let's suppose these are all of the places I operate my business in. Now, for all of these branches that I have in different countries of the world, I will manage the treasury portion, the cash portion from one central place, which will be called my centralized treasury. So this is what you mean by a centralized treasury department. Now there are also options that I either give, all of these subsidiaries of mine their own treasury departments. So that would be called a decentralized treasury management system. But when I'm doing the management of all of these at one place, then it will be called a centralized treasury department. Now let's talk about a few advantages that will be there if we have a centralized treasury department. So advantages of a centralized treasury department. So number one point over here will be that you can keep specialized staff. So that specialized staff will be, having the qualification, they will have the expertise, they will have the experience. So definitely the management can be done in a better manner. Second advantage is that there will be economies of scale. Now, I am such a big organization. I have, my subsidiaries in all parts of the world, India, China, US, UK. So what happens is the fund that gets, accumulated at the centralized treasury includes the funds of all of these subsidiaries. So what I will have over here is going to be a big, huge amount. Now, because I'm managing a huge amount, I will also be able to negotiate interest rates and everything better. Hence, I will also have economies of scale. Now, another advantage over here is pooling. This is similar to, again, to, because we have a centralized treasury, let's suppose India over here is having a surplus. My branch, let's suppose in UK, has a deficit. So what happens is the surplus which I have in my branch in India can be used to fund the deficit that I have in UK. So basically, otherwise, if this was, separate, they were all managing their own treasuries, UK would probably have to borrow money and, pay interest on that. So what happens is, because I am doing a centralized treasury function, I do not have to pay any interest. So I save on the interest which I otherwise would have paid on the deficit which I have in UK. So over here, pooling means netting off. You can net off deficits, cash deficits against surpluses to save interest expense. All right. Then the next advantage that we have is that it increases your negotiation power with the banks. So increases negotiation power with the banks. Another advantage is that it becomes, the more efficient becomes your foreign risk management. So your foreign risk management becomes more efficient. So whatever you're dealing with different currencies, because you're dealing with everything at the same place, you know your entire position, as a business as a whole. So you can do things more efficiently with respect to the foreign risk management also. Now, the person over here at the centralized treasury will be called a treasurer. So the person who looks after the treasury department is going to be called a treasurer. Now let's see what's the role of a treasurer. So treasurer's role. Number one is that he or she has to do an accurate cash flow forecasting. Only when he or she forecasts the cash flows well, then only he's going to be able to, use the surpluses or prevent the deficits. Only when the cash flow forecasting is accurate. Then he will also have to plan short-term borrowings. So definitely, if he finds out with the forecast that there's going to be a deficit, so he can plan to take a short-term borrowing. Similarly, in the opposite scenario where you have a surplus, so planning investment of surplus. Now, another role which he has is that he has to make the cost efficient cash transmission. Now, what do we mean by this point is that, when cash transmission basically means moving cash from one place to the other. So when you transfer big amounts of money, banks levy charges, those are transaction costs, bank charges and everything. So he needs to make sure that, he's not doing a lot of transactions. He's minimizing the cost which is there to, transmit the cash from one place to another. Then another role which the treasurer has is he has to dealing with foreign currency issues. Foreign currency issues. Now he needs to also look about the foreign currency aspect. So like I was telling you, this example over here, we are dealing in different countries. Different countries have different currencies that work over there. So this is how the treasurer is also responsible to look after the foreign currency issues. Then another role that he has to play is that of optimizing bank arrangements. This again means if we are making we are getting a loan, or we're entering into certain contracts. So even these arrangements needs to be optimized so that the cost that the business incurs is minimized, it's reduced to the lowest extent possible. Then another function is that planning major finance raising exercises. So let's suppose the business needs cash, and we are doing it through maybe a bank loan, could be through issue of equity, could be through preference shares, any source which you are using. So the treasurer is also going to have to plan the finance raising exercises. And then he also has to look after the account receivable and payable policies. How much time do you allow your your customers to pay, money to you, and how much time do you take to pay your suppliers? So all of these policies are going to be, again, a part of the treasurer's role. Now, the next concept that we talk about are the reasons why a business will hold cash. So obviously, holding cash for a very big amount is not good, because the cash could have been put into certain investments which, could have given you good returns. So now that you are, holding cash, why a business will hold cash? Number one is transactions motive. So there are three motives that we widely have. Number one is a transactions motive. What does this mean is that businesses will hold cash to meet their current day-to-day financial obligations. Day-to-day financial obligations. So this could be the payroll costs, that means the salaries that you're paying to your employees, could be about the purchases of raw materials. So basically, the money that organizations need for their daily operations is what transaction motives is about. Then let's talk about the other motive, which is precautionary motive. Now, businesses also hold cash because they want to, have a cushion. They want to have certain extra cash against the unplanned expenditure. So maybe we have not planned to spend any money, but, maybe something unexpectedly happens. We have to pay something immediately. So businesses may hold a cushion against unplanned expenditure. And this may also be held in the form of cash equivalents. Now, what are cash equivalents? Which is not directly cash, but it is almost equivalent to cash. So example is treasury bills. So these are very liquid and, can be sold off whenever you want cash. So that's why these are called cash equivalents, because they are highly liquid. They can be converted to cash whenever you want. So this is precautionary motive. And the third motive is your speculative motive. Now, according to this motive, businesses hold cash to be able to quickly take advantage of any investment opportunities that may arise. So, for example, the business has found, that we can take over this company. This company we have been eyeing on, and suddenly the situations have become, more good for us. So in such a scenario, we'll quickly use the cash that we have to buy to take over that specific company. Then if we talk about, we when we talk about the treasurer's role, we said that he has to give an accurate cash flow forecast. So how can forecasts and budgets be prepared? So cash flow budgeting. So basically, if you are, preparing any cash budget, what all are you going to take? You're going to see how much is going to be your sales volume, how much revenue you're going to generate, and then you'll also consider the costs that you have, and then you'll also consider the one-off expenses, which could also be the capital expenditure. So capex is also a part over here. So this is all that you will consider, and even more things that you will consider in cash flow budgeting. Now, obviously, when you're making forecasts, there are always risk and uncertainties when we are operating any business. So what do we do if, we are facing with risk and uncertainty? So risk and uncertainty. So number one is that we can do a what if analysis. Now, what do we mean by a what if analysis? It's also called a sensitivity analysis. Basically, we are trying to, find the effect of any change in anything. So let's suppose, my payment patterns are changing, the time that that I am taking to pay my suppliers, or, the payment patterns of receiving the payments, how late are my customers paying. So we are considering the worst case scenario over here, worst case scenario. Then if I talk about material cost, what will happen if my material costs change? What will happen if my timing of other receipts change? Timing of other receipts. So other receipts could be, if I've sold some non-current assets, so when I get the money for that, and then let's suppose other costs as well, like materials. So we have other costs like uh, labor, overheads. So what will happen if these costs change? And then fifth point can also talk about interest rates. So what will happen if, I have borrowed money at a variable rate and the interest rate go against my favor? So over here also we'll talk about the worst case scenario. This is how, the what if analysis or the sensitivity analysis tries to find the effect of change in any of these factors and how is it going to affect my cash flow forecast. Now, another model through which you can do this is called a simulation model. We have discussed this earlier in the previous chapters also. So there was the Monte Carlo simulation. Basically, over here we were changing one variable at a time. Now in simulation models, we are changing multiple variables at the same time. So it incorporates possible relationships between variables and it generates probabilities for you so that you're able to see that what is the probability of you having this value or this cash flow forecast coming in to you. So this is how you can incorporate risk and uncertainty in your forecasts. All right. Then the next thing that we talk about, let's suppose a business is going to face a, let's suppose a short-term, deficit. So they are going to have to borrow in the short term. So the number one thing that they can do is they can go for debt factoring and invoice discounting. Again, this is something which we have covered and discussed previously, that the businesses can factor their debt, they can sell their debt to some other party, and the other party will give them the money now and they will collect it from the people later. Similar is the thing with invoice discounting. They can they can go to banks and discount the invoice, and then they can obtain the fund right now, but a lesser amount. And another short-term source is your bank overdraft, so bank ODs. And then you can also consider taking a short-term loan from any financial institution. Now, let's suppose business is now in a situation of a surplus. So what leads to basically a surplus? So let's find out what are the sources of surplus funds. Number one could be overfunding. Overfunding means we have raised more debt or more equity and we did not really need that. So those funds were really not needed, but we raised them and hence we have a surplus. So this is the first thing. Second is could be the disposal of surplus assets or divisions. So if I was not using any asset which I had in my business, it was lying vacant, I sold it off. So the money that I received by selling that is also some surplus which I have. And then there could be an operating surplus. This basically means that I have been able to sell a lot of things, and considering all of my subtractions which I do, my fixed costs, variable costs, still I'm left with a lot of money. So this is called operating surplus. Now, let's suppose a business has surplus. So what factors will it consider for investing the surplus funds? So let's see the factors to consider for investing surplus funds. Now we have surplus funds lying with us at the moment. So what factors should we keep in mind before we invest those surplus funds? Number one, we'll see what is the amount of funds that is available with us. So if it's a very big amount, we'll probably go for a big investment. If it's a small amount, we'll go for a smaller investment. And then we'll also see what is our required level of liquidity. So how soon am I going to need that money back? If I need that money back very soon, I will invest in something which is highly liquid, probably like treasury bills. Or if I can keep it in for a longer period of time, then I will choose something less liquid, could be like properties or buildings and everything. Then third thing which I will consider is the risk tolerance. How much risk can I take with these surplus funds? And also the default risk. Wherever I'm investing this money, what is the risk that there's going to be a default? What is the risk that I lose my entire money? And then the fourth thing which I will consider is the expected return on investment. How much return am I expecting on the investments that I make? So this is also one factor which I will consider before I invest my surplus funds. Now, let's suppose I want to invest my money for the shorter period of time. So what are the possible options which I have to invest my money for short term. So my short term investments could be, we are talking about a few sources over here. Number one could be money market deposits or your bank deposits. Bank deposits. Now, what is this? We will, put our money into money market or we'll deposit it in a bank. So what happens with these deposits is that they may have notice period for withdrawals. So let's suppose if you need that money today, you will have to, give a notice well in advance that on this date, I need this money back. So this source may or may not suit you. You see according to your needs. Then one more is a certificate of deposit. You can buy a certificate of deposit. Now this source of investment is more liquid. It's more liquid, but it gives you lesser returns. Another place where you can put in your money is treasury bills. So T-bills, these are very low risk, very liquid, and they give you even lower returns. So the lesser risk you take, the lesser return that you get. So treasury bills, they are very less risky and hence they will give you even lower return. Then there are also gilt-edged securities. These are nothing but government securities. These are long-term versions of treasury bills. Now, these are not recommended if you want to invest short-term surplus because the market price of these securities are very sensitive, is very sensitive to interest rate changes. Any business should only invest in gilt-edged securities if in the short term if they are close to maturity. So if these gilt-edged securities are close to maturity, that means not a lot of change can happen to the market value. Only then you invest in gilt-edged securities. Then you can also invest in other government bonds. Then another place where you can put in your money is certificate of tax deposits. Certificates of tax deposit. So this is nothing but a deposit that you make with the tax authority, and you can either get it back for cash or you can use it in settlement of your tax liabilities. Now, another place where you can put in your money is a commercial paper. Now, commercial paper is, we have spoken about this earlier also, that it's an unsecured short-term debt, which is only issued by very, companies which have a very high credit rating. So it gives you a good liquidity, and because, and also the risk is low because, this is only issued by companies who have a very good credit rating. Then another place where you can put in your money is a corporate loan note. Now over here, the liquidity can be poor and the risk can also be higher than your government bonds or commercial paper. So if only this suits you, then invest your money over here. Liquidity can be poor and risk is higher than government bonds or commercial paper. All right. So the last source that we talk about is going to be equities. So investing short-term surpluses in the equity markets or the stock markets is not recommended. Why? Because these are of high risk. All right. So these are the, places in which businesses can invest their short-term surpluses. Now, the next concept that we have in this chapter is that there are different models of, how much cash a business should hold. So to find out the optimum cash balance that the business should hold, there are basically two models that we will be talking about. Number one is the Baumol model, and number two is the Miller-Orr model. So let's first speak about the Baumol model. So basically this method, this model tries to optimize the amount of funds to transfer from, let's suppose you have two bank accounts. You have one savings account and you have one current account. Now, what happens is you do get interest in your savings account, but there's no interest when it comes to current account. So, Baumol model basically tells you how much money you should transfer from this account to the current account. So that you minimize the opportunity cost of holding the holding the cash in the current account. And basically, this means that it tells you that what's the optimum level of cash, what's the optimum amount of cash which you would be transferring from interest bearing account, which is the savings account, to the current account, because as soon as money reaches here, there's no interest that you get on this balance. So that is why this tells you that what will be the optimum cash that you should transfer, so that you minimize the opportunity cost. Opportunity cost means nothing but the money that you transfer over here, since it does not give you any interest. Opportunity cost is basically the interest which you could have earned had you had you let that money remain in your savings account. So there are a few assumptions also when it comes to this model. Every model which we have studied comes with its assumptions. So number one assumption is that there's a constant annual demand for cash. Now this model is very similar to your EOQ model which we learned for inventory. Second thing is that there are constant interest rates. Third thing is that there is a constant cost of each transfer. Basically meaning, if I transfer the money from savings to current account, what is the cost? And that cost remains constant. Let's suppose the bank levies 5 rupees as transaction charge. So this cost is remaining constant. Number 4 is cash requirements. Whatever cash you need, cash requirements are funded by sale of short-term investments. So whatever cash that I need in the business, I will probably sell off any of the short-term investments to fund that cash requirement which I have. So now let's look at the formula which the Baumol model gives you. So economic transfer, which means the money that you should transfer at once, should be equal to under root of 2 multiplied by CO multiplied by D divided by CH. Now let's see what all are these variables over here. Now D over here represents your annual requirement of cash. CO is nothing but your transaction cost. And then CH is nothing but the opportunity cost of holding cash. That means the interest rate that you get on, basically the difference between the interest rate that you get on your short-term investments and on cash or your savings account. So this is the formula that it has given. Now let's also see what are the weaknesses of this model. So number one weakness is that there are unrealistic assumptions of constant demand. Assumption of constant demand. Now we have mentioned in the assumption that we are assuming constant demand for cash, but in real life the demand for cash in any business does not remain constant. It keeps on fluctuating. Sometimes you need more cash, sometimes you need less cash, so the demand is not constant. Then another limitation is that interest rates and transaction costs are not constant in reality. So this is also one assumption. They have assumed it to be constant, but in reality they are not constant. So this is one more weakness of this model. Then another weakness is that the model assumes that business is constantly using cash. Business is constantly using cash. And must finance this by selling investments. So I will show you the assumption right above, which we have mentioned. So it is this assumption over here that the cash requirements are funded by sale of short-term investments. So this is again a weakness, because it's not necessary that always a business will finance any cash requirement through selling short-term investments. If there are any good businesses, any worthwhile businesses, at some point in time they will generate cash rather than burning it. So because of the sales that you're making, because of, even after you subtract your variable cost, your fixed cost will still left with money. It's not always that a company will continue to burn money. So this is what the weaknesses are. Now the first model is covered. Let's talk about our second model, which is the last topic also in this chapter. So the second model is the Miller-Orr model. Right. So basically, according to this model, your cash balance is allowed to vary between lower limit, which is set by the management. So there's a lower limit which the management sets, and there's an upper limit which is calculated by the model. So your cash, basically the amount of cash fluctuates between this lower limit and the upper limit. So if at all you have reached the lower limit, you will calculate the difference between your returning point and your lower limit, and you will raise more money to bring it back to the return. Basically this model is going to give you a return point. So your cash should return over here. If you are at the lower limit and you want to go back to this level of cash, the difference you will work it out, and then you will raise cash by selling short term investments to bring your cash back to this level. Now another scenario is where your upper limit has been reached and you want to return to this point. So now you have extra money. Now what you will do is you will buy short-term investments of the difference that you have between these two values, so that your money, eventually the money that you're holding, comes to your return point. So there are proper formulae that this model gives you so that you're able to find everything that you have to. Now let's see what assumptions are there, and then we'll see the formulae. So number one assumption is that your cash requirements, again similar to the Baumol model, are funded by sale of short-term investments. And another assumption is that your fixed transaction cost is there per sale or purchase of investment. So no matter you're selling or purchasing any short-term investment, your transaction cost is remaining fixed. This is what they are assuming. All right. So now let's look at the formulae which this model has given us. Number one formulae. Number one is given to find out your return point. This will be equal to your lower limit plus 1/3 of spread. Now, lower limit is calculated by the management. It will be given to you in the question. Now, spread is something which you need to calculate. So, what's the formula of calculating spread? This is 3 multiplied by 3/4 of transaction cost multiplied by the variance of cash flows. How much are the cash flows of the business varying, divided by the daily interest rate. And then this entire thing has to be raised to the power of 1/3. This is the formula to calculate your spread. And one more formula is that your upper limit is going to be lower limit plus the spread. Now you have all three formulae which this model has given us. Let's talk about the weaknesses now. So the weaknesses that this model has is number one, subjectivity in setting lower limit, because it's the management who's going to set the lower limit. So they always have a subjectivity. What may be the lower limit for you may be too high for someone else. And then there can also be complexity of estimating future volatility of cash flows. How much your cash flows are going to differ. Again, this is volatility of cash flows. Now, because we need the variance of cash flows, again over here there can be complexity in estimating this value. And last but not the least is that in practice, in reality, the commissions that you pay, the brokerages that you pay for buying, commissions on buying or selling short-term investments, if not they are fixed, at least they will be partly variable, so are likely to be partly variable. So let's give you all an example over here. So let's suppose if you go out and you want to sell or buy any short-term investments, so usually how they will quote the rate to you is that the transaction cost is going to be equal to 5 rupees, which is a fixed charge, plus 5% of your transaction value. So let's suppose if you are buying shares of, let's suppose, 5,000 rupees. So on that 5,000, 5% will be added to your transaction cost. So 5,000 is the value. I multiply that by 5%. So 5% basically gives you 250 and plus 5. So basically 300 is going to be the transaction charges that you pay on making this transaction. So that is what this weakness is telling, that because they have assumed that there's going to be a fixed transaction charge on buying or selling of securities, this assumption over here, this may not hold true in practice. This is why this becomes a weakness of the model. With this, we are done with chapter number 15 pertaining to cash management. I hope that with this video, you have been able to revise this entire chapter, and I will catch you in the next video for the next chapter. All the best.